Lines of credit. And this is, again, driven all by cost of capital. All right, it's very simple. Less than 1 year. It's the least costly to the borrower. It's least costly to the bank from the standpoint of capitalization. You have lines where they're just simply due on demand. Many borrowers prefer that. They really don't care. It's not that big a deal to them. It's not critical to their business. If they can negotiate a better rate, they'll do so. And that's why a lot of times that you see 364-day facilities, which means that it's just a day less than a year. So for a bank, from cost of capital standpoint, it costs less to the bank to provide this 364-day committed facility to you as a borrower than it does if I give it for 365. So that's why you see it, and it keeps the cost down for the bank and the borrower. All right? Let's look at greater than 1 year. You have, there's a trade-off, cost and flexibility. Typically, it involves the assessment of an unused fee, okay, in excess of 1 year. And you'll see there the rough unused fees per annum, about 25 basis points to 38 basis points. Again, like I said, negotiable. Have I seen them less? Yes, I have seen them less. Have I seen them more? Yes, I have. The big thing there is it depends on what it's going to be used for. If it's going to be used for an acquisition financing, it could cost you a little bit more, okay? But sometimes companies like to have a multi-year facility. And for, they want to sleep at night for whatever reason. Typically, it comes with it. It's a trade-off, all right? I talked about the regulatory cost of capital for committed facilities beyond a year. And again, it's just simply making sure we understand our costs that are being imposed by the regulators simply because of what's perceived as risky versus not so risky. All right? And then I mentioned already about how revolvers are used in acquisition financing, and the things that I've seen, 3 to 5 year revolvers, they typically match the term debt amortization of, say, 5 years with a balloon. So in this case, you can get a revolver 3 to 5 years, and again, you'll typically pay for the flexibility. Any questions on lines and unused fees? Talk a little bit about working capital lines of credit. What we see is typically there are many secured, fewer unsecured, but they're out there. And again, and we're talking in this slide under the world of what we'll call middle market commercial lending, okay? And what I do is typically a hybrid type of lending. I'm not an asset-based lender or a business credit lender that I'm heavy on collateral, okay? And there is a difference. There's those bankers out there that all they care about is the collateral and the underlying value, and I'll get to that in a second. But typically, you could call me a hybrid. I'm looking at cash flow, I'm looking at collateral, all right? I'm looking at some combination of the both. And the same thing with what Lou would look at is some combination of the two. So many times what we do is, for a sense of, especially when you have companies that either are in a growth mode or they have seasonality, all right? There's an ability to track on a monthly basis, for instance, to have this borrowing base certificate, okay, that the borrower submits to the bank to kind of track, their level of usage, all right, and how they match up against the current assets, all right? And then for a rule of thumb, you'll see it many times, 80% qualified accounts receivable, and we can talk about what's qualified. Everything's a little bit different, and it's unique to perhaps your own situation and the industry in which you operate. And the same thing with inventory. What's qualified inventory? Rule of thumb, raw materials, finished goods, that gets counted depending on what work in process looks for you. It may be, it may be just simply removed from a borrowing-based formula when a bank looks at advancing funds for your operation, okay? So I really look at it it's a way for both the borrower in many cases. I have borrowers already that said to me, Tom, I actually like doing my borrowing-based certificate because it's a discipline for them in how they run their business. And even though they have come to a point in their maturity that they really don't need to submit these borrowing-based certificates, but that's part of their discipline. That's part of their financial management, and they want to have a certain level of borrowings against their current assets. So I leave it there. There's many different ways you can skin the cat, so to speak, with how to provide for additional working capital and including borrowing base advance formulas. So